Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Nebius Group, the AI cloud pure play spun out of Yandex's international assets, now one of the fastest-growing GPU cloud providers globally.
Nebius traces its roots to Yandex, Russia's dominant search engine. After Russia's invasion of Ukraine, Yandex's international operations were ring-fenced and separated from the Russian business.
Nebius relisted on NASDAQ in 2024 after a reorganization stripping out all Russian operations. CEO Arkady Voloshin, Yandex's co-founder, returned to lead the new AI cloud entity from Amsterdam.
Arkady Voloshin has served as CEO since Nebius's relaunch. A Yandex co-founder, he built it into Europe's largest internet company before exiting in 2022 and pivoting to AI cloud infrastructure.
Most recently, Nebius reported revenue up over 400% as AI cloud demand absorbed all GPU capacity. The company remains unprofitable, reinvesting every dollar into cluster expansion.
The revenue model is straightforward. Enterprises pay per GPU hour for AI training and inference compute. Nebius's clusters run near full utilization. Demand is outpacing capacity expansion.
The core moat is capital-intensive GPU infrastructure. Nebius operates multi-data center NVIDIA GPU clusters across Europe and North America, an asset base taking years and billions to replicate.
Talent depth is a secondary moat. Nebius inherited Yandex's ML research culture, engineers who built large-scale AI systems before Western startups existed. That institutional knowledge is irreplaceable.
The long-run thesis is AI sovereignty demand. European enterprises require cloud-meeting EU data residency rules, a structural advantage U.S. hyperscalers cannot satisfy from American soil.
Against AWS, Azure, and GCP, Nebius competes on GPU availability, compliance posture, and speed rather than breadth. For AI-native workloads, GPU availability often matters more than services depth.
The global AI cloud market is growing at rates that make the enterprise software wave look modest. Every model training run and inference deployment requires GPU compute that is structurally undersupplied.
The near-term risk is execution at scale. Building GPU data centers reliably requires specialized engineering. Scaling too fast without operational discipline creates reliability and margin risk.
Concentration risk is real. Nebius depends heavily on NVIDIA GPU supply chains. Any disruption to NVIDIA supply, pricing, or licensing could constrain the infrastructure build and compress unit economics.
The path to profitability is uncertain. Nebius is in aggressive build-out mode. Every dollar of margin is reinvested into capacity. Investors must trust the unit economics at scale rather than current earnings.
The AI tools portfolio, including Toloka data labeling and 1010 developer education, provides optionality beyond raw GPU compute. But cloud infrastructure is the primary value driver right now.
Geopolitical exposure has been resolved by the Russian separation, but Yandex heritage perception remains a structural discount on Nebius's multiple.
At roughly $40 million in market cap for a company with $680 million in annualized revenue, Nebius is priced for category leadership, a bet that European AI cloud demand does not abate.
Nebius just reported surging AI cloud revenue as the former Yandex spin-out races to become the pure-play GPU cloud for European and global AI builders.
Let's get into the GPU infrastructure build and what the Yandex transformation means for the long-term moat.
GPU cloud, AI infrastructure, and a transformation from Yandex to AI pure-play. Nebius is betting European sovereignty demand creates a durable, non-hyperscaler cloud market. Now let's get into the numbers.
1 year ago, Nebius Group was generating almost no revenue. Today, it reported $399 million in a single quarter, 684% year-over-year growth. The company built this by doing one thing: filling Europe with NVIDIA H100 and H200 GPU clusters faster than anyone else. When the world needs AI compute, Nebius is the infrastructure that shows up.
Welcome to Charged Alpha. I'm Lana, here with Hudson. Today we're breaking down Nebius Group's Q1 2026, the AI cloud infrastructure company that went from near zero to a $400 million revenue run rate in 12 months by building the GPU infrastructure that Europe actually needs.
Quick orientation. Nebius Group, ticker NBIS, is headquartered in Amsterdam, Netherlands, with approximately 3,800 employees. The company was reorganized from Yandex's international technology assets following Russia's invasion of Ukraine and relaunched as an independent AI cloud provider targeting European and North American enterprise and research customers.
Nebius operates full-stack AI infrastructure, GPU-dense compute clusters for model training and inference, managed machine learning platforms, fine-tuning tools, and foundation model APIs. The company's data centers are in Amsterdam and Helsinki, with expansion underway across Western Europe. Founder and CEO Arkady Volosh, who built Yandex into Russia's Google, leads a team that retained most of Yandex's international engineering talent.
The positioning is deliberate. European enterprises and governments face regulatory pressure to keep AI workloads within EU data sovereignty frameworks, meaning they cannot easily run sensitive AI on AWS, Azure, or Google Cloud without complex compliance arrangements. Nebius provides compliant EU-based GPU compute at competitive pricing, capturing a market that the hyperscalers are structurally slow to address.
Q1 2026 revenue came in at $399 million, a 684% increase year over year from approximately $51 million in Q1 2025. The consensus estimate was $320 million. Nebius beat by $79 million, a 25% revenue beat in absolute terms, the kind of upside that rarely happens at a company growing this fast.
On the earnings line, adjusted operating EPS was negative 23 cents versus the negative 78-cent consensus estimate, a 55-cent beat. The adjusted loss is narrowing rapidly as utilization scales against the fixed cost base of the GPU infrastructure. Each additional GPU hour sold flows through to gross profit at near zero marginal cost, and the 42% gross margin in Q1 reflects this operating leverage kicking in.
GAAP EPS was positive $2.40, a large positive number that requires context. That figure includes $780.6 million of non-cash equity revaluation gains from the Yandex restructuring and related financial instruments. The GAAP number is not representative of operating performance. The adjusted operating loss of negative 23 cents is the operative metric, and it's improving fast.
Capital deployment is the story behind the revenue story. Nebius deployed over $500 million in GPU infrastructure CapEx in the single quarter, purchasing H100 and H200 clusters, expanding its Helsinki data center, and signing new capacity agreements. The CapEx exceeds revenue in Q1, which is typical for infrastructure businesses in rapid build-out phase. The investment today generates the revenue of the next 6 to 12 quarters.
Gross margin of 42% is already impressive for a company this early in its infrastructure ramp. Comparable GPU cloud businesses at similar scale have often operated at 20 to 30% gross margins. Nebius's higher margin likely reflects a combination of premium pricing for EU-compliant compute, efficient cluster utilization management, and favorable long-term NVIDIA supply agreements negotiated during the initial capital raise.
The forward revenue trajectory implied by the Q1 run rate is significant. $400 million per quarter annualizes to $1.6 billion in revenue for calendar 2026. With GPU capacity still being added and utilization expected to improve each quarter as the newest clusters fill, the annualized run rate could exit 2026 materially above that. Management has guided conservatively to $2 billion for the full year.
Arkady Volosh founded Yandex in 1997 and built it into Russia's dominant search and technology platform before relocating to Israel and ultimately Amsterdam following the invasion of Ukraine. He holds a controlling stake in Nebius. On the Q1 call, Volosh emphasized that EU AI sovereignty demand is structural and multi-year, not a one-year surge, and that Nebius is capacity-constrained, not demand-constrained, at current prices.
Wall Street's consensus on Nebius is very bullish, with 8 buy ratings and 1 hold at an average price target of $50 against the current price near $40. The bull thesis is straightforward. GPU compute infrastructure in Europe is in structural shortage. Nebius is filling that shortage faster than competitors, and the margin trajectory as utilization scales points toward eventual profitability on a timeline that is pulling forward.
JP Morgan's overweight rating is based on what they call the first-mover infrastructure advantage. The EU cloud market is approximately $150 to $200 billion in total addressable market, and AI workloads are growing as a share. Nebius, as the dedicated EU-compliant AI compute provider, does not need to win a large portion of that market to justify its current valuation. It needs to win the AI-specific slice, which is growing at triple-digit rates.
Goldman Sachs's buy reflects confidence in the unit economics trajectory. At 42% gross margin, with the cost base of the existing clusters effectively fixed, each additional dollar of revenue beyond break-even generates extremely high marginal contribution. The path from negative 23 cents per share in Q1 2026 to adjusted profitability in 2027 or 2028 requires only modest revenue growth beyond current run rate.
The lone hold reflects concern about hyperscaler competitive response. AWS, Azure, and Google Cloud are not standing still. All three have announced EU sovereign cloud initiatives with dedicated regions and data residency guarantees. If they price aggressively or partner with European telecoms to provide compliant infrastructure, the demand that currently flows to Nebius could be captured by better capitalized incumbents who can afford to underprice to win strategic market share.
NVIDIA supply risk is the second concern from the hold camp. Nebius's entire value proposition depends on continuous access to NVIDIA's most advanced GPU architectures at scale. Any allocation shift, export control change, or competitive GPU architecture from AMD, Intel, or custom silicon could disrupt the supply chain that Nebius's business model is built on. The company has no meaningful non-NVIDIA compute offering today.
The bull case starts with the EU sovereignty premium. European enterprises paying a premium for Nebius's compliant compute are not just buying GPU hours, they are buying regulatory certainty, legal residency of their data, and the ability to use AI in regulated industries, including finance, healthcare, and government, that cannot operate on U.S. headquartered hyperscaler infrastructure without extensive compliance overhead. That premium is durable and growing.
The margin trajectory makes the bull case even more compelling. At 42% gross margin in Q1 on a capital base that is largely fixed, every additional quarter of revenue growth at current utilization rates converts at a very high marginal rate into EBITDA. The math suggests that if Nebius sustains $2 billion or more in annualized revenue, adjusted EBITDA turns positive in 2027, making this a profitability inflection story as much as a growth story.
The bear case centers on GPU supply dependency and hyperscaler competition arriving simultaneously. AWS's EU sovereign cloud, Azure's EU data boundary, and Google's EU resident compute offerings are all in various stages of launch. If these products gain regulatory credibility with European enterprise buyers, the demand that drives Nebius's current revenue growth rate could decelerate faster than the CapEx investments can be recovered through utilization.
The gap loss structure creates a credibility risk with certain institutional investors. The $780 million non-cash equity gain in Q1 2026 dramatically distorted GAAP EPS to positive territory, but that gain was a restructuring artifact, not a business result. Any future periods where restructuring gains do not offset operating losses would produce large GAAP losses that could trigger systematic selling from funds with GAAP-positive screening requirements.
And the geopolitical history of the predecessor company is a genuine overhang. Despite Nebius's legal independence from Yandex Russia, the founding team's origin and some investor base's association with Russian technology creates reputational friction in certain institutional sales processes. European government customers in particular have shown sensitivity to vendor country of origin risk, which could limit Nebius's penetration into the highest value sovereign cloud contracts.
Options activity on Nebius was extremely call dominant following the Q1 results, with the put-call ratio sitting near 0.45, reflecting near-unanimous short-term bullishness. Call buyers concentrated at the $45 to $55 strike range for the August and November expirations, positioning for continued quarterly revenue acceleration as new GPU cluster capacity comes online in the second half of 2026.
Implied volatility is elevated at the 88th percentile of Nebius's short trading history, reflecting the binary nature of the investment thesis. The IV profile is consistent with a company where the outcome distribution is wide, Either GPU demand fills the new capacity and revenue compounds, or utilization plateaus and the CapEx cycle becomes a weight on returns rather than a growth engine. The market is paying for optionality in both directions.
Insider alignment is high. CEO Arkady Voloshin retains a controlling stake and has been increasing his equity exposure through new grants tied to utilization and revenue milestones rather than time-based vesting. No insider selling was reported in Q1 2026, and given that Voloshin relocated his family and rebuilt his entire professional life around this company after leaving Russia, his personal alignment with the stock's success is difficult to overstate.
The primary catalyst for Nebius is quarterly revenue acceleration, confirming the utilization ramp. If Q2 2026 revenue comes in above $450 million, a 12% sequential gain, it would validate management's claim that the newest cluster capacity is filling faster than prior cohorts, suggesting each marginal dollar of CapEx is generating more revenue per unit of time than the early deployments.
A major enterprise or government partnership announcement would be transformative. Nebius operates on a commercial customer basis today: startups, AI labs, and mid-size enterprises. A contract with a large European government agency, a major financial institution, or a Tier 1 model developer like Mistral or DeepMind would simultaneously validate the product quality, extend revenue visibility, and reframe the stock from a speculative compute provider to a strategic infrastructure company.
The key risks are GPU supply disruption, hyperscaler competitive pricing, and the geopolitical association with the company's Russian origins that limits its addressable enterprise customer universe. Any NVIDIA export control expansion that restricts GPU availability in the EU would force Nebius to ration capacity rather than expand it. And any high-profile loss of a major customer to AWS or Azure's sovereignty cloud offerings would signal that the premium pricing Nebius commands is starting to erode.
That's the Nebius Group Q1 2026 breakdown: 684% revenue growth to $400 million in a single quarter, a 55-cent EPS beat as losses narrow and margins expand, and $500 million in GPU CapEx deployed to build the infrastructure that powers the next phase of growth. Subscribe to Charged Alpha, and you'll see where this goes when Q2 lands.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.